It is no stretch to say that after this week, the era of big government is back. To counter the most severe financial crisis since the Great Depression, the federal government has become the world's biggest insurance company, its biggest mortgage lender, and is now asking Congress for $700 billion to buy up the bad assets of American financial institutions. This series of moves has put a stunning number of taxpayer dollars at risk, more than $1.3 trillion. About twice what the government spends on health care each year, double the entire cost so far of the Iraq War. Here to answer our questions this morning, the architect of the plan, Treasury Secretary Hank Paulson. Welcome.
George, good to be here.
I know you've been working around the clock for several weeks, so thank you for your time. And let's just start out with the scope of this plan. I know President Bush was reluctant to get into it, but he said that he was convinced by your team that the risks of doing nothing are far greater than the risks of acting. Tell us what you told him. What are the risks of doing nothing?
What I said to the president is what I'm going to say to the American people, is that last week, as the credit markets were frozen, the capital markets were frozen, we had a situation where American companies weren't able to borrow money. This could ultimately affect small banks, loans to businesses, loans to farmers, jobs, people's retirement. And this is a situation we can deal with and we need to deal with. And it began with excesses in the system, irresponsible behavior and practices in financial institutions. It then spread to, because there's irresponsible borrowing also, we saw the pain and suffering in terms of foreclosures, then the chain reaction, George, to financial institutions, illiquid assets. And so what we are recommending is that the government buy illiquid assets in big size from the institutions. These are what are clogging up the system so that they can play their role they need to play.
I want to get to that in a second, but just to focus on where we were at the end of last week, I was told by several members of Congress who were briefed by you and Chairman Bernanke, Fed Chairman Bernanke, that you all basically had the message that we were days away from a financial catastrophe.
Well, what I've said, George, is that the situation we had, where markets are frozen and lending may not be available, is one that won't be good for the American people. And the way to protect the American people is to come in and stabilize the system by purchasing these illiquid assets from the banks. Now, you mentioned the cost, and the cost to the taxpayer. And the fact that the taxpayer is in this position is painful to me. But I don't think it is fair to compare that with spending for health care or Social Security.
Why not?
Because this is not traditional spending. This is money to purchase illiquid assets. Those assets will be held and will be sold. But
we don't know how much we're going to get for it.
No, we don't. No, the ultimate cost, it would be extraordinary if the ultimate cost was not well below what the headline number is.
Well, except that at the beginning of when those S&Ls were bailed out, the initial cost, it was supposed to be $50 billion. It turned out to be $160 billion.
Right. Yeah, but here, those were cost estimates. In terms of what was paid here, I'm only making one point. I'm not saying that there's not going to be a considerable cost to the taxpayer, but I'm saying when you look at the money that is spent to purchase assets that will be held and sold, and the price you will get for those assets will be based upon how the economy does, the pace at which the housing markets recover. But the ultimate cost will be well below what was actually spent for the assets. It could be a considerable cost. And I don't like the fact that the American taxpayer is bearing that burden, but it is far better than the alternative.
That's if it works. There are several observers who are concerned that this is not going to work. Joe Nocera in yesterday's New York Times said that the Treasury had actually contributed to a crisis of confidence because of what he called confused actions. You don't step in to save Lehman Brothers last week, then several days later, an about-face, step in to save the American International Group. He concludes that the Treasury Department has actually contributed to the biggest problem in the market right now, an utter lack of confidence.
Well, I think there's going to be a lot of commentators, a lot of second-guessers. George, all I can say was, first of all, we moved very fast dealing with Fannie Mae and Freddie Mac. And I look at that situation as living up to the responsibilities of the United States of America. These problems were created with congressional charters many years ago and with ambiguities, and we moved very quickly, and it was very fortunate for all of us that that was stabilized before Lehman's earnings were announced. Lehman Brothers was a very sad situation. There weren't buyers for Lehman Brothers. I don't know what the government could have done in the case of Lehman Brothers.
So no second thoughts on that?
With no buyers. I feel bad. It was a tragedy. But in terms of those that want to second-guess AIG, after you have Lehman Brothers go down, that to have another huge bankruptcy in a few days, and AIG much bigger and interconnected throughout the system. That touches money market funds, people's 401ks. This is a situation where there are 50 different insurance regulators, very little oversight at the holding company, a hedge fund on top of insurance companies. This is, I can't explain how we got there, but in terms of the action by the Fed in coming in there, supported by Treasury, I certainly don't second-guess that.
Yeah, it wasn't enough. And what if this new plan doesn't work? Someone who was briefed by your team said this plan was described as the last wrench in the toolbox. What if it doesn't work?
Well, this is something that has to work. I very much believe it will work. You know, George, we work our way through these situations as a people. We always get through these situations, and we will get through these situations. And the key here is to get through this with as little negative impact on the American people as possible.
Let's talk about some of the details. The original legislation we saw said that you would be buying up the mortgage-related assets from financial institutions having headquarters in the United States. Yet last night, the fact sheet put out by the Treasury seemed to expand that. It said only that the financial institutions have to have significant operations in the U.S. and that you could waive that at your discretion. So will foreign financial institutions be eligible to have their assets bought?
Yes, and they should, because as you think about this, if a financial institution has business operations in the United States, hires people in the United States, if they are clogged with illiquid assets, they have the same impact on the American people as any other institution. That's a distinction without a difference to the American people. The key here is about protecting the system. Now, I need to say to you that we have a global financial system, and we are talking very aggressively with other countries around the world and encouraging them to do similar things, and I believe a number of them will. But remember, this is about protecting the American people and protecting the taxpayers. And the American people don't care who owns the financial institution. If the financial institution in this country has problems, it'll have the same impact whether it's U.S. or foreign owned.